Welcome to your technical and sentiment report for the Nifty 50. In this video, we will analyze the market action from July 9th, 2026 and build a playbook for the upcoming session on July 10th. By the end of this session, you will be able to analyze the July 9th relief bounce using price action and market breadth, identify key Fibonacci levels and sentiment indicators for the next session, and implement a strategic trading plan based on 3 probable market scenarios. The Nifty 50 closed on July 9th at 23,962.80, marking a gain of about 80 points or 0.34%. This confirmed a relief bounce after a period of intense selling. Crucially, breadth confirmed the move. Advances improved to roughly 33 advancing versus 17 declining by the July 9th close, showing broad participation. To understand why this bounce matters, we need to look at the internal health of the market, often called market breadth. On July 8th, the market was in a state of capitulation, with only 4 stocks advancing against 45 declining. However, by the close of July 9th, the script flipped. We saw roughly 33 stocks advancing and only 17 declining. This is a crucial signal. It tells us that the move higher was supported by broad participation across the index, rather than just a few heavyweights pulling the average up. When more stocks participate in a rally, the move is generally considered more sustainable. Next, let's examine the put-call ratio, or PCR, which measures market sentiment through the options market. During the session, the intraday PCR started at an extremely bearish level of 0.60. This indicates that traders were heavily hedged or betting on further downsides. As the relief bounce took hold, this ratio unwound, climbing toward 0.90. The near-month cumulative PCR now stands at 1.11, while the volume PCR is at 0.95. These numbers suggest that the market is no longer stretched in either direction. We've moved from extreme fear back to a balanced positioning, giving the market room to move without the immediate pressure of being overcrowded. Let's look at the price action on the candlestick chart to see exactly how the bulls defended their ground. Early in the session, price dipped toward the 23,780 to 23,800 zone. This was a perfect retest of the July 8th low and aligned with the 0% Fibonacci reference point. The market held this level, forming what we call a double bottom on an intraday basis. From there, it pushed up to a high near 24,150. Tagging the 38.2% retracement level. Notice the upper wick on the July 9th candle. The close at 23,962 means the market gave back some gains. This suggests late session profit booking rather than a clean, aggressive trend day. It is a sign of caution. Traders are not yet willing to hold long positions blindly into the next day. For the best trading experience, use the Dhan trading platform and our referral code. Don't forget to like and subscribe to Index Orbit. To plan our next moves, we must identify the walls and floors using Fibonacci retracement levels. We anchor these levels from the July 8th high of 24,450 to the July 8th low of 23,780. The level at 24,151 acted as a ceiling during the July 9th intraday session. If we gap up on July 10th, the 50% retracement at 24,230 becomes the next major battleground. To call this a strong recovery, we need to see the index stay above this level with solid breadth. The 61.8% level at 24,309 is the golden ratio. Reclaiming this would be a significant bullish signal. On the downside, the 23,900 to 23,960 zone is our first line of defense. If that fails, we look back at the double bottom support at 23,780. A break below 23,780 would likely lead us toward 23,565, which is the critical May swing low. Losing that would break the entire medium-term recovery structure. Use the Dhan trading platform for the best trading experience. Use referral code EJZZSI96380. Like and subscribe to Index Orbit. The setup for July 10th looks quite supportive, largely driven by global cues. As of late evening on July 9th, the gift Nifty is trading at 24,079. up 0.35%. In the US, indices closed firm, with the Nasdaq leading the way, up over 1.4%. Crucially, the volatility index, or VIX, has fallen 4% to 16.22. A falling VIX usually signals a risk-on environment where traders are more comfortable buying. Combined with the broad participation we saw in the July 9th bounce and the unwound options positioning, the higher probability path for July 10th is a gap-up opening followed by a test of the 24,150 to 24,230 resistance band. This is a much stronger setup than a typical dead cat bounce, but we must remain objective and watch for signs of exhaustion. For the best trading experience, use the Dhan trading platform with referral code EJZZI96380. Like and subscribe to Index Orbit. Now, let's look at our scenario playbook for July 10th, starting with scenario A, which is our base case. This scenario assumes the bounce extends, aligning with the positive global cues we just discussed. The trigger for scenario A is a gap up that successfully holds above the 23,900 to 23,960 zone throughout the session. If this holds, our targets are the Fibonacci levels at 24,151, then 24,230, and potentially the golden ratio at 24,309. Expect some heavy selling pressure or chop between 24,000 and 24,100, as this is where fresh open interest was built. Think of this as a booking zone, unless market breadth stays exceptionally strong all day. A smart strategy here is a bull call spread, for example, buying the 24,050 call and selling a 24,200 call. This allows you to capture the upside while capping your risk if the rally stalls at resistance. If you prefer income, a put credit spread below 23,800 can monetize the newly rebuilt support. For the best trading experience, use the Dhan trading platform. Use referral code EJZZI96380. Like and subscribe to Index Orbit. What if the gap up fails? This brings us to scenario B, rejection at resistance and a potential rollover. In this case, the market might open high but face immediate selling. The trigger is if the price loses the 23,900 to 23,960 support intraday after rejecting the 24,050 to 24,150 resistance band. If this happens, the double bottom at 23,780 is back in play. However, be careful if that support breaks on a second attempt. It is much more significant and likely leads to a deeper slide toward the critical May swing low at 23,565. The strategy here is patience. Do not pre-position shorts just because of a gap up. Wait for confirmation, such as a close back below 23,780 on weakening breadth, before shorting. If you want to fade the resistance directly, use a small-sized bear call spread. But remember that this is currently the lower probability path given the global backdrop. Finally, we have scenario C, trend reversal confirmation. This is the most bullish outcome and requires more than just a morning pop. Scenario C is triggered if we get a sustained close above the 24,230 to 24,309 range, with breadth genuinely improving. This would confirm that the sharp drop on July 8th was just a flush or a temporary shakeout rather than a fundamental change in the market trend. A close in this territory opens the path back toward the July 8th high of 24,450. If this happens, your strategy should shift from fading rallies to buying dips. You might consider an outright 24,200 call option or a wider bull call spread targeting that 24,450 level. This is the signal that the bulls have fully regained control. Before you place your trades for the open, there is one final piece of the puzzle to check: the FII and DII data. The institutional print for July 9th is the single most useful confirming data point. If the data shows strong domestic institutional buying against foreign institutional selling on this bounce day, it supports the idea that this is a durable retracement, aligning with scenarios A or C. However, if the print shows that foreign institutional investors remained net sellers even as the price rallied, It raises the odds that the bounce was largely driven by short covering. In that case, the rally is more likely to stall again at the 24,150 to 24,230 resistance, which is the hallmark of Scenario B. Always check this print before sizing your positions meaningfully. At the end, use the Dhan trading platform for the best trading experience. You can use the referral code EJZZI96380. Like and subscribe to Index Orbit. In summary, July 9th delivered a broad-based relief bounce that reached slightly beyond its initial target before some late-session profit-taking. We have analyzed the 33 to 17 breadth improvement, identified key Fibonacci levels at 24,151 and 24,230, and outlined scenarios A, B, and C for July 10th. With Gift Nifty and global cues both looking constructive, the higher probability path is a test of the 24,150 to 24,230 resistance band. Treat the 24,000 to 24,100 zone as a contested area and watch the 23,565 level as your ultimate line in the sand on the downside. To execute these strategies with precision, I recommend using the Dhan trading platform. It offers a seamless experience with advanced features like the option scalper and detailed heat maps that we used in today's analysis. Use the referral code EJZZI96380 to get started today. If you found this breakdown helpful, please like the video and subscribe to Index Orbit for daily technical and sentiment reports. Trade responsibly, and I'll see you in the next one.